This is Your Money, Your Wealth.
Hey, welcome to another episode of Your Money, Your Wealth. Joe Anderson here, certified financial planner alongside the big man, Big Al Clopine, sitting right over there. Got a great show lined up. Here's the deal. I'm a little frustrated today. What is the biggest obstacle you think that is in front of you to have a successful retirement? Okay, we've had some volatile markets over the last, let's say 3 or 4 weeks. And most people will say the stock market, but it's not. It's you. It's your behavior to the stock market is the biggest thing that's stopping you to accomplish your financial goals. October 15th, the news just came out. $5.8 billion flew out of mutual funds, stock mutual funds. So when the market drops 1,000 points, what are you doing? You're getting out of the market. That's the last thing that you want to do. Two of the biggest reasons why you're not successful financially is that you're not prepared when markets go down. And secondly, you do not have a tax plan. In Al and I's opinion, taxes will take way more from you than the stock market ever will, but you don't necessarily have a plan for taxes, and you don't have a plan for your stocks or your portfolio. That's what's on my mind today. So a couple of things I want to get into. I want to bring Bing Crosby, now Big Al, into the mix. And I want to dive in and talk a little bit more about taxes on the retirement distributions and some of the behavior. If you have a plan in place, control the things that you can control. You can control your risk in your portfolio. You can control the fees and the costs and the commissions of what you're paying your broker, your brokerage house. And then finally, you can control the taxes if you have appropriate plan. So let's bring Big Al in. My man, a lot of things out there, a lot of scary stuff. The markets go down, the markets go up. Warren Buffett's losing billions of dollars and then he's gaining it back. People are freaking out. What do people do?
Well, it's a good question, Joe. And really, we can't necessarily control the market, but we can control our reactions to the market and we can control our taxes to some extent. And a lot of understanding and controlling taxes is simply understanding what taxes are. So we could spend show after show after show, but today we're going to focus on your retirement accounts and understanding what's possible with your retirement accounts. Like, first of all, when can you take those dollars out? When are they available? There's certain ages depending upon which type of accounts. And then the second thing is how are they taxed? And a lot of you may be surprised how they are taxed. They're actually taxed at ordinary income rates, the highest of tax rates when you pull those dollars out of most retirement accounts. And then if you do it wrong, if you make mistakes, there are numerous penalties, starting at 6% on some penalties, all the way up to 50%, 50% on certain types of penalties. So you don't want to make those mistakes. And then we're going to bring this all together throughout the show with various strategies that you need to understand. Because here's the thing, if you understand what the rules are with your retirement accounts, you can save tens of thousands of dollars through retirement, in some cases hundreds of thousands of dollars in retirement. And then it's like, so if I can save this tax money, I can either have a more robust retirement or maybe I don't have to take as much risk in my portfolio, so when it is volatile, then I don't see my portfolio swing nearly as much. And Joe, I think it's really all about education, figuring out what you can control and then coming up with a plan to take care of that.
Well, if you think about it, let's look at retirement plans in general. When they first came out, it was under ERISA in 1974. In 1974, so like the defined contribution plan, so your 401k, your 403b, that you're placing money now into the retirement plan and letting it grow tax deferred. You got a tax deduction putting the money in, but back in 1974, the top marginal rate was 70%, 70. And then if you take a look at the history over the last, 40 years, the financial services industry has told you to do this. Save as much as you possibly can pre-tax inside these 401k plans. Let it grow 100% tax deferred. And then when you're in retirement, you can pull the money out and guess what? You'll be in a lower tax bracket. Well, that's true for many of you that haven't saved. But for those of you that watch this program, that listen to our radio show, that are our clients that come in, you have done a really good job of savings, but unfortunately now, tax rates started here and they're going down. The stock market is all over the board, so people have lost money in stocks. In our opinion, you're going to lose even more to taxes because of how the taxation system works today. It's not a one-dimensional tax system, Al. There's so many different rules and laws that have just come into effect just in the last year, and we'll see more and more of that coming up in the next years, in the next few years to come.
Yeah, no question. So let's get into this. Let's talk about what some of the rules are with regards to your retirement accounts. So when you've got a, the question is, when can you withdraw money? And the answer is, when you have an IRA, it's 59 and a half years of age. When you have a 401k and you're separated from service, either you quit your job or you retired, it's actually 55 years of age.
Yeah, this is a big deal here, because if I want to retire early, right, you want to keep the money in the 401k plan, because at 55 there is no 10% penalty. If I move it over to an IRA and I take the money out prior to 59 and a half, then you're assessed a 10% penalty. Any dollar that's in an individual retirement account, you have until age 59 and a half, or you have to wait until 59 and a half to avoid that 10% penalty, unless you do a 72T tax election, which we'll get into later.
We'll get into that momentarily. But the next thing is, so we can take money out at 55 and at 59 and a half for IRAs and 401ks, but when must we take money out of our retirement accounts? And the answer is, with an IRA, it's 70 and a half years of age. We have to start taking money out. That's called a required minimum distribution. And with a 401k, it's also 70 and a half years, with one exception. It can be longer if you're still working and still active in that 401k. So if you're 72 years old and you're still in a 401k and you're still employed, then you don't have to take that required distribution until the year after you retire.
And then, so that's another reason why you want to keep it in the plan, because if I'm still working and I'm in my 70s and 80s, hopefully you're still not working in your 80s or 90s, but if you are, you do not have to take that required distribution until April 1st, the year after you retire. So remember that. If I'm still working, I'm still an active participant in my retirement account, you do not have to take that mandatory distribution. Now, mandatory distributions, the law came out and says, you know what the heck is an RMD anyway? When you're 70 and a half, you are mandated by law to take income, if you want it or not. So at 70 and a half, it's a certain percentage, and as you age, they want more and more and more of that money to come out of that retirement account. So if you think about it, when you started saving money into these retirement accounts, you got a small tax deduction, and then it grew tax deferred for you. Then you turned 70 and a half, you got this big pot of money here that you don't necessarily need because you have Social Security, pensions, real estate income, and the like, or whatever. You are mandated by law to pull that money out. And why? Because they want their tax money. If you do not have a strategy in place to reduce the tax burden long term, I'm telling you, the IRS will take way more than they should.
Yeah, Joe, let's get into how you actually are taxed. And some people are surprised when we talk about this. So really, if you look at the way 401ks are taxed, IRAs are accounts, there's pre-tax dollars. In some cases, there's post-tax dollars. Pre-tax dollar means when you put money into an IRA or 401k, you got a tax deduction. So when you pull the money out, since you never paid tax on it, you have to pay ordinary income tax rates, which, by the way, are the same rates that you've always paid for your salary, interest income, rental income, and so forth. It's the highest of rates. Now, in some cases, you put money into these plans without a tax deduction, and in that case, then you don't have to pay taxes on that part. But let's go over a little example so that you kind of get a sense of this, and that is, if you have a $50,000 distribution in retirement, and let's say you're in a 25% tax bracket between federal and state. So what's that mean? That means your tax is $12,500. You don't get the $50,000, you only get $37,500. And a lot of people don't realize this. The money that's in your IRA and 401ks is not all yours. You've got to pay taxes on that, and you get a net amount, just like a salary.
Right. If you want 50 grand, you got to pull out 6250 or even more, because the more money that you pull out, of course, the more of that is going to be taxed as ordinary income, and then more and more money goes to the IRS. Don't let that happen to you. Get a strategy in place. What we're going to give away today is a free retirement assessment. Let's take a look at what you're trying to accomplish and figure out ways to mitigate the taxes long term. I'm telling you, if you do this right, you will save tens, if not hundreds of thousands of dollars. You can only control the things that you can control, and taxes is one of them. Call the number right now, 888-994-6257. It's at the bottom of your screen. Call that number right now. Get into our office. It's absolutely free. There's no obligation. Call the number, get in, get straight on your finances, because there's a lot of things that you want to make sure that you do before the end of the year. We're going to take a break. We'll be back in just a second. Show's called Your Money and It's Your Wealth.
So the question this week is, I have a retirement plan at work, so where should I be saving my money? Well, what you want to find out is whether or not there is a Roth component inside your 401k plan at work. So since 2006, Congress has enacted where you can now have plan sponsors authorize Roth 401k contributions into the existing retirement plan. So you want to look to see if your plan has the Roth 401k availability. Plan sponsors, over 60% of them have adopted the Roth 401k. It's a great place to start saving on an after-tax basis, and it still has the same contribution limits as the traditional 401k. So you want to look to your tax bracket to see if it makes sense to be going into the traditional 401k, or if it would make more sense if you're in the lower brackets to be contributing into the Roth 401k. Now be aware that once you make a contribution into the Roth component, you would not be able to transfer the funds back into the pre-tax side of the traditional 401k. But once your money is in the Roth 401k, it's now growing tax-free for the rest of your life.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, Big Al next to me. Thanks for tuning in each and every Saturday. Talking retirement planning and more importantly, tax planning when it comes to the distributions from your overall retirement accounts. This is going to be big because there's more and more and more money going into these retirement accounts. And unfortunately, I really don't think that you really understand the true impact of the taxes. That's what we're going to get into the rest of the show. But before we do that, let's get to the true-false question.
If I am still working past age 70 and a half and I'm contributing to my company's 401k plan, I can delay the required minimum distribution until I retire. And the answer to that is true for that account, and that's the key, for that account. So here's how it goes. Typically with an IRA and a 401k, you need to start withdrawing money out of those accounts at age 70 and a half, but there is an exception. And the exception is if you're still working in a 401k plan, you can delay it until April 1st of the year following you retire. So that could be 75 years old, it could be 80 years old, and so forth. Now, in some cases, people actually have old 401ks. If their current plan allows it, you might even want to consider rolling that old plan back into the new 401k of the new employer, because then you won't have to take required distributions on that. So that can be a pretty good deal.
Yeah, when you take a look at the biggest beneficiary, I think, of these retirement accounts, Al, is the IRS.
Yes,
and,
of course.
And the biggest thing is that you really have to truly understand these accounts, because if you have, let's say, $1 million in your retirement account, you truly don't have $1 million because you are partners with the IRS. They are going to take their piece. And so the problem is this, is that more and more baby boomers are retiring. And here's a real quick example of a huge mistake that can blow you up very quickly, is that an individual just retired. They have a very large pension of about $100,000 plus their Social Security and everything else. They're making $150,000 total income. Great income, they don't spend a lot, so they had a ton of income. They had also accumulated $1 million in their retirement account. So think of that. How beautiful a retirement is that going to be, right? You got a $150,000 income, $1 million in your 401k plan. Life is great until this happened. He had a $350,000 mortgage. Okay, so when they go into retirement, most people say, hey, I want to be debt-free. I have a $150,000 pension. I have $1 million sitting in this account. I'm going to take $350,000 out of my retirement account to pay off my mortgage, because that was his only liquid assets. They had about $10,000 or $20,000 sitting in cash, but the bulk of the liquid assets was all in the retirement account. So he takes $350,000 out of his retirement account, pays off the mortgage. Now he feels, hey, I have $150,000 income. I just paid off my mortgage. This is going to be the best retirement ever until April 15th of next year. Because do the math. He got $150,000 of income. Then he took out another $350,000. So that's $500,000 total income. Al, what do you think the tax would be on that? $500,000.
Yeah, probably federal and state, couple $100,000.
Another $200,000 of tax. Where does he have to go to pay the tax? You guessed it, back to the retirement account. another $200,000 out of the retirement account to pay the tax. Wait a minute, now that's $350,000 of income the following year. Now he owes another $100,000 of tax. Where does he have to go to pay the tax? You guessed it, back to the retirement account. Let's pull out another one. It's tax upon tax upon tax. It will blow people up. That's why we're so passionate about talking to you about you've got to find a way to diffuse this. There's also a ton of penalties. If I'm taking money out the wrong way, the IRS is not going to be the biggest beneficiary, but there could be penalties if you don't understand the rules.
Yeah.
So let's take a look at some of these penalties.
Yeah, and I guess the first one really is if you take it out early withdrawal penalty before 59.5 on an IRA or 55 on a 401k when you're retired, there's a 10% penalty. A lot of us know about this and realize the 10% penalty is just the penalty part. You also pay income taxes on top of that. If you make too much of an IRA contribution or 401k contribution, it's an excise tax of 6%. And then the big one is if you forget to take your required distribution at age 70.5, they charge you a 50% penalty. Can you imagine a 50% penalty? So let's say you're supposed to take a $50,000 required distribution and you forget to do it. So your penalty is $25,000 plus you got to take that distribution. So be careful of that one.
So Al, why don't you go over to the whiteboard and let's talk about some strategies, because there's a new tax law that just came out, and I'm telling you that this is going to be one of the biggest things ever, is that it's going to help you basically build a tax-free income. If you have after-tax contributions inside your 401k plan, I'm telling you, this is going to be very, very important that you understand this new tax law. I'm telling you, it came out about a month ago. So if anyone that is watching this program that has after-tax dollars, pay attention, because Big Al is going to show you how you can save tens, if not hundreds of thousands of dollars long-term inside your retirement accounts.
All right, so this is brand new, just about 2, 3, 4 weeks ago. And this is for what happened with the old law. You had a 401k, okay? And the IRS said you can roll that 401k to an IRA. And a lot of people do that. Roll that to an IRA. So that's not a bad idea. Why would you do that? Well, if it's in an IRA, you're going to have more investment choices. You have more control over it. We did a whole other show as to why you might not want to do it, but many people want to roll that out. Well, let's say you have $100,000 in here, and $10,000 is post-tax, meaning you put money in where you didn't get a tax deduction. And so you're allowed to roll that out, but now it's the same character in the IRA. $10,000 is post-tax. Let's say you have a $100,000 account, so 10% is post-tax, which means when you withdraw, 10% of the amount will be tax-free. So that's not too bad, but now there's a much better way. Here, watch this. With this new law, your 401k, this is what you can do. You can take the post-tax one, and now you can put that into a Roth IRA. Now that's $10,000 going into a Roth IRA. Why is that important? Now all future growth on that $10,000 is 100% tax-free. You don't have to take a required distribution out of this. You can let it grow as long as you want. Now the other $90,000 that's still in, you can roll that to an IRA. No problem there. But now you have control. You can take a distribution from your IRA. You pay tax on that. You can take it from the Roth and you don't pay tax on that. You have control, and all future growth is tax-free here in this Roth. It's not the case here. You're just stuck with that original $10,000. For those of you that have post-tax dollars in your 401k, this is gigantic. You want to take advantage of this. It's a big deal.
Yeah, any employee that has a 401a or any type of plan that is post-tax, you want to make sure that you maximize that. So there's different employers around San Diego, Orange County, LA, that they have a post-tax plan where you don't get the tax deduction going in. It grows 100% tax deferred. But here's the big deal, is that before it was like commingled, right? It was hard to separate it. It was like taking a cup of coffee and putting cream in it and then trying to separate the cream from the coffee. Unless you're a scientist, it's pretty hard to do that. Now, the law states that you can segregate the accounts and then have that money grow tax-free for you directly into a Roth IRA. If you have a post-tax plan, call the number right now, get into our office for a free retirement assessment. We will help you understand the tax code, what's available to you, and then we can help you achieve financial freedom. So call the number. It's 888-994-6257. It should be right below me, but it's not. So I'm going to continue. There we go. And then we're going to continue to talk about the number. 888-994-6257.
Hi, I'm Mike Bernier with Pure Financial Advisors. And did you know that 250,000 Americans are retiring every month? And of those Americans, the average retirement account size is $25,000 to $100,000?
Hey, welcome back. Happy Saturday morning to you. Hopefully you're enjoying your weekend. Thanks for tuning in today. Show's called Your Money, Your Wealth. My name's Joe Anderson, president of Pure Financial Advisors. Check us out on the web if you like at purefinancial.com. And of course, I'm always with the big man, Big Al Clopine. Hey, a couple of things. Right now, there's a lot of things that you want to make sure that you consider from a tax perspective before the end of the year. So what I'm offering is that if you want to get educated, I teach a retirement planning course all over Southern California. We look at how do you create the retirement income that you need long term, what are some of the pitfalls that you definitely want to avoid. We look at how do you build an overall portfolio. How do you kick out the middleman? Because there's huge conflicts of interest in the financial services industry when it comes to fees, costs, and commissions. You can do this on your own if you get the right information and education. So if you'd like to attend any of these courses, you can just go to yourmoneyyourwealth.com and you can scroll down and you can look at, all right, well, where is a school next to me? And then click and register and we can get you set up. yourmoneyyourwealth.com. Highly encourage you to check it out. We still have a few classes left before the end of the year. And then, of course, starting in January, we'll ramp right back up again. I think I teach anywhere from 60 to 80 courses a year. So check us out, yourmoneyyourwealth.com. Let's go to the true-false question.
Even though I'm under 59 and a half, I can withdraw money from my IRA to pay for my son's college education without paying the 10% early withdrawal penalty. And the answer to that question is true. It's not widely known. Now, we don't recommend that because that IRA money is for your retirement, not for your kid's education. But just be aware, even when you're younger than 59 and a half, you can pull money out for certain reasons. Higher education is one of them. Certain medical expenses is another one, or if you have total or permanent disability would be another one. And there's something called where you can get a series of payments before 59 and a half. As long as it's a regular payment stream, you can avoid penalty. In each case, though, you'll still pay the income tax, so don't forget that
Yeah,
part.
that's a good point, Al, because I think sometimes it's like, all right, well, I'm disabled. Can I take the money out of the retirement account without the 10% penalty? Yeah, you can take it out without the 10% penalty, but you still have to pay the ordinary income tax on it. It's a little unfair in some cases, but that's still the law. Speaking of the law, big man, we got some new tax legislation that just came out talking about retirement plan contribution limitations for 2015. So the IRS is so generous, they're able, they're just really boosting up of how much that we can put into these plans.
Yeah, so 401k in 2014, it's $17,500 as far as the contribution amount. 2015 just announced $18,500 more. And for those of you that are over 50, the catch-up contribution went from $5,500 to $6,000. So starting January of 2015, if you're over 50, you can put $24,000 into your 401k, where it was $23,000 in 2013. So every little bit helps. It's not a big change, though.
Yeah, I mean, seriously?
So the other thing I will mention is with regards to Roth contributions. So they changed the income limitations there as well. So now when you're single, it's $116,000 to $131,000 of income, adjusted gross income to be exact. That's where it starts phasing out. So if you're single and you make less than $116,000, you can put the entire $5,500 Roth contribution in. If you're married and you're below $183,000, same thing, $5,500, $6,500 if you're over 50, but by the time you get to $193,000, it's completely phased out, and you can't do that Roth contribution.
Yeah, I guess to reiterate, so they gave us a couple of bucks that you can increase inside your 401k plan. If you're over 50, they gave you an extra $1,000 that you can max out, okay? With Roth IRAs, nope, they didn't give us anything there, so it's still the same. So if you've been maxing out your Roth IRA contributions each year, it's $5,500. That's what it was for 2014 right now. And it's exactly the same next year. $5,500 if you're over 50, they still have that $1,000 catch-up, $6,000. So Not great news, in my opinion, but I guess, like Big Al said, a little bit helps. So let's go try to get an email question in, and then let's get out of here for today.
All right, here we go. This is from Nancy in Carlsbad. If I'm going to be in the same tax bracket in retirement as I am today, is there an advantage for me to do Roth conversions?
Absolutely, without a doubt. I think this is some of the biggest confusion out there when it comes to retirement planning and people that are taking a look at this type of tax planning. You absolutely want to do the conversion if your tax rate stays the same. In a Roth IRA, you have so much more flexibility. There is no required minimum distribution. There is no income in respect to decedent if it goes to the kids. It will grow tax-free for your life. It will grow tax-free for your spouse's life. It will grow tax-free for the kid's life. I'm telling you, when they first established the Roth IRA, they wanted to call it the American Dream IRA. The American Dream IRA. But Senator Roth has a huge ego, and he put his name on it. So, with that being said, you absolutely want to take advantage of the Roth IRA any way that you can. So if you're going to stay in the same tax bracket, take advantage of it. Do it. You got until 12/31 before the end of the year to get any type of this planning complete. Call our office if you'd like to come in and we can help you. We'd be more than happy to. Go to our website, purefinancial.com. Listen to us on the radio. Big Al and I have been on the air for almost, 10 years, 760 KFMB. Have a wonderful weekend, everyone. Thanks for tuning in. For Big Al Clopine, I'm Joe Anderson. You're watching Your Money, and it's Your Wealth.